The Bank of Korea will hold its monthly monetary policy meeting later this week. The market widely expects the central bank to keep the key rate steady at 1.5% for the fifth straight month. Hwang Ji looks into what's behind this forecast.
Korea's benchmark KOSPI joined a global sell-off on Tuesday as investors pondered a possible rate hike from the U.S. Federal Reserve next month. Shares were down nearly 1.5%, closing at 1,996.59. It's the first time in about a month period that the index dipped below the 2,000 mark. But many don't expect panic in the global financial market down the road, even if the Fed actually does raise its interest rate.
The pace of the rate hike would be gradual, more so than any other of the Fed's past hikes. So it's unlikely that a rate rise in December will take a drastic toll on the global economy.
Still, given the temporary shock that the Fed's decision is expected to have on the local financial market, experts say that the Bank of Korea will not cut its key rate any further, at least through the end of the year. The central bank slashed the interest rate 4 times in just over a year to a record low 1.5%, riding on the government's drive to prop up the ailing economy.
The Fed's rate rise will prompt capital outflows from Korea, which will cause more uncertainty in the local market, where shares of the export-driven economy are already suffering from sluggish global demand.
Korea is also showing signs of picking up pace thanks to improving domestic demand, giving the central bank extra time to gauge the impact of its previous cuts. The economy grew 1.2% in the third quarter from the previous one, beating market forecasts and posting the strongest quarterly growth since 2010. Hwang Ji, Arirang News.